Hi, I'm Pattu from freefincal. Let's talk about aggressive hybrid funds versus a low volatility index. Such a comparison was asked by several readers, viewers after the review of the UTI low volatility index fund. So let's take a look at this. So let's start with the 5-year rolling standard deviation. This is the volatility, the standard measure of volatility used. So the white one is the Nifty 50 TRI, and the brown is the Nifty 100 low volatility 30 in TRI, and the green is the CRISIL hybrid 65% equity, that is BSE 200, and 35% of CRISIL composite bond. So this is the CRISIL hybrid 65-35 aggressive index. So you can see that the CRISIL index has got the lowest of volatility. That's understandable because the low volatility index is 100% equity, whereas the CRISIL index is only 65% equity. So you can imagine the hybrid index to have the lower volatility. Now let's compare the drawdowns, that is a fall from a previous maximum. So the black line is the hybrid index and the red line is the low volatility index, and you can see that the black line has got a little bit lesser drawdown. So the fall from a maximum is lower in the case of a hybrid index, again because of the lower equity percentage. And if you now look at the 5-year rolling returns, the blue line on the top is the low volatility index, the white line is the Nifty 50, and the brown line is the aggressive hybrid index. So if you look at compare the white line and the brown line first, you can see that the brown line, that is the hybrid aggressive hybrid index, is actually has got a comparable return to that of Nifty. That is why asset allocation is called as the free lunch. That is, just by replacing 35% of equity with bonds, you can get a significantly lower volatility, but the return is comparable to that of Nifty. So the risk adjusted return in the case of the hybrid index is excellent. So if at all somebody launches a aggressive hybrid index fund, I will be very happy to sign up for that. And because you're getting Nifty like returns at much lower volatility and much lower drawdown. So that's an excellent feature of the aggressive hybrid index. But if you compare that with the low volatility index, typically the low volatility index has performed a little bit better. The quantum of outperformance may not be always the same, but it has generally tended to outperform over 5 years. We don't have data for producing longer duration returns. Now, if you compare the risk-adjusted returns, if you look at the beta, that is the volatility, relative volatility, the aggressive hybrid index has got 63% of the market volatility, whereas the Nifty low volatility index has got 76% of that of the market volatility. Then you have the other risk-adjusted measures like Alpha, Sharp, Sortino, and Trainer. So this I have measured since 2011, January 2011. That's when you have data for the aggressive hybrid index. So for the last 10 years or so, maybe 11 years or so, it's this is the data. And I don't want to explain to you what the Sharp, Alpha, Sortino ratio is. There are I have made videos on this and other articles, you can refer to that. But the upshot of it is that if you look at the risk adjusted measures, the low volatility index has done a little bit better than the aggressive hybrid index. So for those who want low volatility but also seek a little bit better return than the Nifty, the low volatility index is a good idea. Those who want low volatility but comparable returns to Nifty, then the aggressive hybrid index is a good idea. Of course, the actual aggressive hybrid funds, all of them are currently actively managed. They will hold slightly higher equity than this index. So now let's take a look at the reduced return versus reduced risk. So reduced return versus reduced risk means we are now calculating the 3-year return of aggressive hybrid funds minus the 3-year return of the hybrid index. The risk also the same way, risk of the 3-year standard deviation of the aggressive hybrid fund minus the 3-year standard deviation of the hybrid index. So in this plot, which goes from something negative to something positive, something negative to something positive in the x and y axis, right at the center, the 0,0 point is the position of the hybrid index, that is the CRISIL hybrid index, So relative to that, you have these 4 zones: lower risk, higher reward, lower risk, lower reward, higher risk, lower reward, and higher risk, higher reward. And you can see there are some dots which are the hybrid index which have got higher risk but lower reward. Some of them have got, many of them I should say, have got higher risk and higher reward. And you can see that the red dot is the low volatility index. It has got slightly better reward than the than the hybrid index over 3 years. The situation is more or less the same over 5 years, and you can see that again the low volatility index has done better. However, if you look at the rolling returns with respect to CRISIL hybrid index, very few funds have done better. That is, if you look at our monthly mutual fund screeners, and only 6 out of the 30 available aggressive hybrid funds have consistently outperformed the hybrid index. So it is not easy to find a good actively managed hybrid index. So that's also a problem. So if you ask if an aggressive hybrid fund, index fund is launched, is it a good replacement for a Nifty index fund? It is certainly a good replacement for both the Nifty index fund and also existing actively managed aggressive hybrid funds. Of course, things matter like expense ratio, tracking error, AUM, all those matter. But aside from that, the idea of an aggressive hybrid index fund is extremely welcome, and hopefully that will be launched soon. Now, what should I choose between suppose we have an aggressive hybrid index fund, what should I choose? Should I choose the low volatility index or should I choose the aggressive hybrid index? If you just want low volatility and comparable market returns, you should use the hybrid index. If you want to try and beat the market at low volatility, then the low volatility index is the better idea. In my opinion, because the low volatility index removes the fund manager risk, it is a better idea than investing in that is a better idea than actively managed aggressive hybrid funds. Of course, I have invested in the NFO offer, but for you, I would recommend, for new investors particularly, I would recommend just wait and watch, see the performance and AUM, expense ratio, etc., and then you can take a call. Don't be in a hurry. I don't mind being in a hurry. I mean, I have graduated those stages of uncertainty, lack of conviction, and so on. I just don't care. But if you are worried about these things, then you should wait and take a call.